Before you make another financial decision based on your tax bracket, watch this video. I've talked to executives making $400,000 a year who turned down a $75,000 bonus because they thought it would cost them money. Doctors who refused to do Roth conversions because they were worried about being in too high of a bracket, or business owners who left $40,000 on the table every single year because of a myth that they learned in a conversation at a cocktail party. Here's what nobody told them. Moving into a higher tax bracket has never, not once in the history of the US tax code, caused someone to take home less money. And in the next 15 minutes, I'm going to prove it to you with real numbers, show you exactly where this myth comes from, and give you a framework that will change how you make every financial decision for the rest of your career. Let's start from the beginning. The United States has what's known as a progressive marginal tax system. That word, marginal, is everything. It means that each dollar you earn is taxed at the rate that applies to that specific dollar based on where it falls in the income range. Here's how it works with real 2026 numbers for a single filer. Your first $11,925 of taxable income is taxed at 10%. The dollars from 11,926 up to 48,475 are taxed at 12%. The next bracket, going all the way up to $103,350, is taxed at 22%. Up then the next one up until 197, tax 24, and so on, as you can see from this graphic. Now, here's a critical thing to understand. Say you earn $300,000 a year. You are not paying 35% on all 300,000. You're paying 10% on the first chunk, 12% on the next chunk, 22% on the next, and so on. Only the dollars above $250,000 are taxed at 35%. The dollars below that threshold are taxed at a lower rate that applies to them. Let's put some actual numbers to this. A single filer with $300,000 in taxable income pays roughly $74,000 in federal income tax. That is the effective tax rate. Total tax divided by total income, or about 24.7%, not 35%, not 37%, about 25 cents on every dollar on average. So when someone says, I'm in the 35% bracket, what they actually mean is that their last dollar of income, their marginal dollar, is taxed at 35%, not their average dollar, not their first dollar, their last dollar. And here's the most important implication of all of this. Earning more money never ever makes you take home less because the higher rate only applies to the additional dollars above the threshold. Every dollar you earn still nets you more than zero after taxes, regardless of what bracket you're in. That is the myth, fully dismantled. But let's keep going because there's more nuance worth knowing. So, where does this myth come from? Why does it feel so intuitively true? Part of it is just math anxiety. Tax brackets are presented in a table with percentages that go up, and it's easy to assume the percentage applies to everything. That's an understandable mistake. But there's also a kernel of truth behind this, and this is important because there are situations where earning more income creates a disproportionate tax cost. They're not just the ones that people think. One is the Social Security taxation threshold. If you're receiving Social Security benefits and your combined income crosses certain thresholds, up to 85% of your benefits become taxable. Cross the line and a dollar of additional income doesn't just get taxed, it also pulls money from your Social Security into the taxable column. That creates an effective marginal tax well above your stated bracket. This is a real cliff, and it's the one that retirees need to plan around carefully. There's also what's known as IRMAA, or the Medicare Premium Surcharges. This one hits high income earners directly. IRMAA, the income related monthly adjustment amount, is a surcharge added to your Medicare Part B and D premiums in your taxable if your taxable income exceeds certain thresholds. And these thresholds are cliffs, not slopes. $1 over the line and your Medicare premium jumps up by hundreds of dollars a month. For 2026, a single filer with income above $106,000 starts paying the surcharge. The jump at each threshold can add $1,000 or sometimes even $4,000 more a year in premiums. There's also what's known as the capital gains rate cliff. Long-term capital gains are taxed at 0, 15, or 20% depending on your income. There are specific income thresholds where the rate jumps. If you're right below the 20% threshold, realizing just one more dollar of capital gains pushes the rate on to your proportional gains from 15 to 20%. This isn't catastrophic, but it's worth being aware of when timing assets. Here's the bottom line. Tax cliffs are real, but the tax bracket myths are not. The distinction matters because planning strategies are completely different, and getting them confused leads to bad decisions. Let's talk about what bracket anxiety actually costs executives in practice, because it's not just theoretical. It shows up in real decisions all the time. Let's say turning down bonus or deferred comp. I've had conversations with executives who generally consider declining deferred compensation elections because they were worried about the tax hit. Let's run the math on that. Say you're offered the opportunity to defer $50,000 of your bonus into a deferred comp plan. You're in the 35% bracket. If you take the money now, you pay $17,500 in federal tax immediately and invest the remaining $32,500. If you defer it, the full $50,000 stays invested and grows tax deferred until distribution, when you'll likely be in a lower bracket. The decision to defer it almost always is better, but bracket anxiety makes executives hesitate or worse, decline entirely because they're focused on the wrong number. The next mistake I see is avoiding Roth conversions. This one's extremely common. Executives in high brackets often dismiss Roth conversions entirely because I'm already in the 35% bracket. Why would I pay the tax now? But that misses the actual analysis. The question isn't your current bracket in isolation. It's whether your current rate is higher or lower than your expected rate at distribution. If you're going to retire with $5 million in pre-tax accounts generating $200,000 a year in required minimum distributions, you may be in a higher bracket in retirement than you are today. In that scenario, converting now at a 35% rate beats paying 37% later. Bracket anxiety shuts down the analysis before it even starts. The other is leaving employer matches on the table. This one is rare, but it happens. I've spoken to people who reduced their 401k contribution because they thought getting the match would complicate their taxes. The employer match is free money, a 50% or 100% immediate return on your contribution. There is no bracket math that makes declining irrational. The cumulative cost of these decisions over a career is significant. Avoiding a $50,000 Roth conversion opportunity every year for 10 years invested at 8% is over $780,000 of tax-free wealth you didn't build. That's the real price of this myth. So if bracket anxiety is the wrong framework, what's the right one? Here's how I actually think about tax planning with executive clients. Start with your effective tax rate, not your marginal rate. Your effective tax rate, which is the total federal tax divided by total gross income, is your real number. It's what you actually pay, on average, across every dollar you've earned. For most high-income executives, this number lands somewhere between 22 and 28%, despite being in the 35% or 37% bracket. Calculate it, write it down, that's your baseline. Now the question becomes, what legitimate strategies can move that number down over time? One is income timing and bunching. One of the most underused strategies for executives is timing when income hits. If you have flexibility over when a bonus is paid, when a stock is sold, or when deferred comp is distributed, shifting income tax between tax years can keep you in a lower rate in high income years and use lower brackets in lower income years. This requires forward planning. You need to know what your income picture looks like in 12 to 24 months. But for executives with variable compensation, it's one of the highest leverage moves available. Another is deferred compensation elections. If your employer offers a non-qualified deferred comp plan, this is one of the few tools available to generally reduce your current taxable income above the 401k limit. You're not avoiding tax, you're just delaying it to a year when you expect to be in a lower bracket. The planning question is always, what do I think my income will look like at distribution? If the answer is significantly lower than today, deferring makes sense. If the answer is about the same, the analysis is a little bit more nuanced. Another is Roth conversions in low income years. The best time to do a Roth conversion is in a year when your income is temporarily lower than usual. A gap between jobs, early retirement before Social Security, a year with large deductions. In those windows, you can convert pre-tax IRA or 401k money to a Roth at a lower rate than you would pay it later. Another strategy is tax loss harvesting. When you have capital gains from selling company stock, rebalancing a portfolio, anything, strategically harvesting losses elsewhere in your portfolio to offset those gains is one of the cleanest tax deduction tools available. Capital losses can offset capital gains dollar for dollar, and up to $3,000 of excess losses can offset ordinary income annually, with the rest carrying forward. I want to tell you about a conversation I had with a client couple a couple of years ago that illustrates all of this perfectly. He was a senior director at a large tech company, making about $380,000 between base salary, bonus, and RSUs. Very smart guy, very financially aware. When his company offered a deferred comp election, he came to me and he said he was going to pass on it. His reasoning was, I'm already in the 35% bracket, deferring it just delays the inevitable and complicates things. We sat down and actually mapped it out. His plan was to retire at 58. Between his 401k, his IRA, and his deferred comp, his projected retirement income, including required minimum distributions at 73, would put him squarely in the 22% to 24% bracket, not 35 or 37, 22. So deferring $70,000 of his bonus into the plan saved him $26,250 in federal tax in the current year. Taxes he would eventually pay at a 22% rate instead of a 35% rate at distribution. The lifetime tax savings on that one election, present value, is over $40,000. He made that election, and then we built a proper multi-year tax plan, layering deferred comp, Roth conversions in low income years, strategic RSU sales, tax loss harvesting, all reduced his effective tax rate by nearly 4 percentage points over 5 years. 4 percentage points on a $380,000 income can be anywhere around $15,000 a year. Compounded over a career, that's a life-changing amount of money. And it started with understanding that his tax bracket was not the enemy. That's the kind of planning that I do. If you're an executive and a tax strategy has always felt confusing or overwhelming, I promise you it does not have to be. It just needs to be explained clearly and applied to your specific situation. Let me leave you with the 3 things that I want you to remember from this video. Number 1, tax brackets are marginal. Higher brackets only apply to the dollars above the threshold, not everything that you earn. Earning more always nets you more. Number 2, tax cliffs are real. IRMAA, Social Security, phase-ins, capital gains, all those are worth playing around, but they're specific and identifiable. Don't confuse them with brackets. And number 3, your effective tax rate is your real number. Know it, track it, and build a plan that moves it down over time through legitimate, legal strategies, not bracket avoidance. If you want to talk through your specific tax picture, what your effective rate actually is, whether deferred comp or Roth conversions make sense for you, or how to build a multi-year tax strategy, that's exactly what I do. The link to book a free consultation is in the description.